Good afternoon, everyone. My name is Helder Raposo, and I'm a financial wellness coach for Hanscom Federal Credit Union. I have been a part of the Hanscom team for a little over 5 years now. Accompanied with me today is Liz Clarke, who is our mortgage loan officer, and Bill Burpo. Bill Burpo is also a financial wellness coach, and he will be here with me today assisting with the chat. We strongly encourage questions during this session. Liz is really good, and this is where we learn everything that we need to know before jumping out in the big world. So if it's more of a personal question, feel free to chat myself or Bill directly. Before I hand this over to Liz, she has been working in mortgages for 10 years now. She has also always worked for companies that are not for profit. Liz has been a part of the Hanscom team for 7 years now, and prior becoming a mortgage loan officer, she was a teacher. She is a wealth of knowledge. She is the OG, which is the original maker of this presentation that we have been advancing on now. And she brings a wealth of knowledge and great information to the table. And I hope everyone finds this session useful. Liz, the floor is yours. If you need me, I'll be here in the background.
Awesome. Thanks, Helder. All right. Good afternoon, everyone. So as Helder mentioned, I am a mortgage loan officer at Hanscom Federal Credit Union, and I am going to be going through some information for you today about how to buy a home now or in the future, some tips and tricks and things that I think you ought to know in order to be a successful home buyer. And as Helder mentioned, feel free to jump in with questions, and I'll be sure to get them answered for you. All right. So the main steps that we're going to go through today are exploring your financing options and pre-qualifying. That's usually going to be your first step, looking into how much you qualify for and eventually starting that pre-qualification or pre-approval process. The next step is finding an agent that fits well with you and your personality and someone who you can trust. The next step is making offers and signing a purchase and sales agreement, and then completing your financing with the chosen financial institution. So I would imagine that the majority of you out there are first-time home buyers. And what is a first-time home buyer? So that is going to be someone who has not owned a home in the last 3 years. Sometimes you will be buying a home as a couple, and sometimes one of the two individuals buying the home has in fact owned a home in the last 3 years. That is completely acceptable as long as one of the multiple borrowers who are looking to buy a home hasn't owned a home in the last 3 years. You are considered as a unit a first-time home buyer. And as a first-time home buyer, you have benefits that are available to you. So one of the major benefits of being a first-time home buyer is being able to make a small down payment, or sometimes being eligible for a program that does not require a down payment. Additionally, several towns and cities and government organizations may offer down payment assistance programs if you are considered a first-time home buyer, and oftentimes that's in combination with income restrictions or for folks who fall into certain income brackets, such as low income. So those are some of the major first-time home buyer benefits. There are also specific loan types that have some benefits that we'll talk about later, such as adjustable rate mortgages that are designed for first-time home buyers that may have certain safety features built into them. All right. So then as you are exploring the process, you're going to come into contact either over the phone or online, occasionally in person with certain people in the home buying process. So the first, you'll talk to a mortgage loan officer. That's someone like me who oversees the whole process from when you're first starting to talk about how do I start saving for a home, how do I improve my credit, or what do I need to do to apply. So that's an MLO or mortgage loan officer. You're going to work with a buyer's agent. 99% of folks will end up working with a individual buyer's agent who will help you to find the home that you buy. They are operating in your best interest, so they are going to make advised opinions and suggestions for how to make an offer the best way so that you can have your offer accepted. And they're only going to advise things that are truly in your best interest. That's their responsibility as a buyer's agent. A listing agent is going to be helping the seller get the very most amount of money that they can get for the sale of their home. So occasionally, and in some states, you can in fact work with a dual agent. So that would be when the listing agent is willing to assist you as your agent, as a buyer's agent, and they're also supporting the seller as the listing agent. This does happen periodically if there's not a lot of challenges in the process, and it's just simply an easy way if you're in agreement with the seller about the price, and that's something to consider, although it's oftentimes considered very hard for agents to do this and balance the competing priorities of your interests and the seller. But it's definitely something to read a lot about or talk to your mortgage loan officer if you end up in that situation. Additionally, there are title companies. In some states, actual real estate attorneys are required to be present and to handle a mortgage closing. In Massachusetts, that's the case. Otherwise, a title company is a sufficient organization to handle the research on the property and end up handling your closing. This is always going to be paid for you as the buyer, even though some of the work to handle the closing is for the benefit of the lender who's giving you the mortgage. You as the buyer are going to be responsible for the cost of the title work or the attorney's review and preparation of documentation. Additionally, you can choose to hire your own attorney to review all documentation. That's always going to be done at your own cost. But many people choose to have an attorney review everything just to give them a sense of confidence in their decision. A lot of times people work for organizations that offer free legal support, and oftentimes this benefit that's given to you as part of your employment package may have a contract with real estate attorneys who are willing to do that for you. So it's always good to check your employee benefits. And then lastly, a seller is almost always going to have an attorney. It's unlikely that you'll have much contact with them unless you are purchasing a home that is for sale by owner. So some sellers will choose to sell a home without an active real estate agent relationship in order to save some of the costs associated with working with realtors. And they may choose to sell it directly to an individual and just use an attorney. And so that would be the only time that you might have an actual relationship with a seller's attorney. All right. And so one of the big questions that I hear from buyers is if you need a real estate agent at all. And people understand that if you were to purchase a home without a real estate agent, there may be a way to save some money on the purchase of the house. And the first thing I want to say about that is that as a buyer, you do not pay a real estate agent out of pocket. The cost of working with a buyer's agent, their commission, which right now is ranging from 2 to 3% of the sales price of the home, that gets paid to them by the seller once the home sells. And Although occasionally people are successful in working without a real estate agent, the amount of information and skills that you would have to complete all of the paperwork and purchase and sales agreement and all of that is really quite a challenge. So real estate agents tend to have usually the expertise and the knowledge to make proper estimates of value and to help you make a proper offer on a house. They also will have contacts for properties that may not yet be listed, which is a way that you can get into a home faster than other competition and may have an advantage over others. If there are things that need to be negotiated, a real estate agent is the one who has typically has that conversation about negotiating either a change in the sales price of the home if the home ends up valuing less, or if there are repairs that come up as a result of a home inspection. They understand all the different contingency clauses that can go into a real estate contract that can help protect you if you were to need certain levels of protection. And the other thing is that real estate agents do require almost across the board, they do require that you sign contracts with them. And that's so that if they end up doing work for you and show you homes, that if you do purchase that home, they are entitled to that commission on assisting you with that home purchase. However, I do want to let everyone know that those contracts, although they will offer you a very standard real estate contract for you to sign to work with them, you have the ability to request adjustments, and you can tailor a contract however you want. If you are looking at one house that's out of the range of the geographical range of an agent that you do like, and you want to go and look at a property, let's say in Maine, southern Maine, even though you're generally looking in New Hampshire, let's say, and you work with a Maine agent, you can have a contract to work with them just for one home that they show you. So you have a lot of power in the home buying process, and contracts are things that can be adjusted to meet your needs. So right now, as I imagine you all are aware, in most of the country, people are in bidding wars or making there are multiple offers on every home because we have a shortage of real estate available in this country. So there are challenges that come up when you are offering to purchase a home for more than the asking price. Typically, the asking price for a home has been determined by the seller and their agent, and they've determined that that might be a reasonable value for the home, and that they anticipate that the home would value in the current market for that amount. Unfortunately, when folks are offering significantly above the asking price of the home, they are willing to pay more than the home is actually worth. This isn't something that happens all that often in other parts of our daily life. If someone was offering you a really delicious loaf of bread for $18, that isn't something that people are going to make, additional offers on. So it's not something we're too familiar with. We want to pay, generally speaking, the price that something is worth. And at the end of the day, the lender is the one who determines that value. So when you purchase a house, if you've, for instance, you've agreed to pay $500,000 for a house, and the lender completes a home appraisal that inspects the interior of the home and then verifies that information based on other homes that have sold and based on historical information, as well as the actual details and specs of the property. And they determine that the home is not worth $500,000 that you have agreed to pay. You have a few options. The first option is if you have a appraisal contingency, or you have written into your contract that you can negotiate if the value is less, then you can try and renegotiate the deal. You can attempt to have the seller agree to sell you that house for less than it's worth. There's the option that you could contest the appraisal, or pay for a second appraisal to be completed if you thought that there was something wrong with that valuation. But the most common solution here is that you make up the difference in cash. So if the lender determined that the home is worth less, you pay that difference and it does not go towards your down payment. So you have to have sufficient funds to pay for any delta in the value and the down payment amount if you are choosing to make a down payment. Additionally, if you have the sufficient clauses, you could choose to walk away, or wait it out to see if other potential buyers have the same situation. So this does come up a fair amount right now because there are so many folks who are overbidding on properties, and it's something that your mortgage loan officer can go through with you and make sure that you, if you plan to buy in this current market, that you have enough funds and the ability to compete with other people for these properties.
So a question came in on that, Liz.
Yeah.
Just about your recommendation.
Yeah.
What do you recommend as far as overbidding for a house? Is that something that you recommend to people doing or not doing, or?
Yeah, I mean, it's really, it depends on your situation. So if you are in a place where it makes the most sense for you to be buying a home right at this time, and you found the home that you plan to live in for a long time, and this is the house you want, and you have the means to overbid, and then it's not really overbidding if the value to you is the price you're willing to pay. Even if it doesn't match the value that the bank or credit union determines, if it could be worth $50,000 over asking price to you so that you have the home that you need for yourself and or your family. Of course, when you pay more for something, something that is likely to depreciate in value over time, either a short period of time or a long period, there is always a certain level of risk. If you purchased a home and then the following 2 years later, the home had lost a lot of value, if the market changes and you wanted to sell, you may not make back the money that you had paid. So in that situation, there could be risk of a loss of money. But for someone who really wants a property, and it absolutely can make sense to do, it's just truly an individual situational determination on that.
So thank you. It sounds like it has to do with your risk level.
Yep.
And also it's very situational.
Yes.
All righty. Thank you, Liz.
Thank you.
Keep those questions coming. They're awesome.
All right. So now we're going to talk more about what lenders want to see from you. So these are the main pillars of what a lender really cares about in seeing from you. So first and foremost, a lender wants to know that you have sufficient income to support your payment. Could be all of the different sources of your income. It doesn't have to be from employment. These are, you can use things that come to you in the form of income from child support or alimony. You're able to use Social Security income. There are benefits that you might receive. There's a lot of different sources of income that may be considered by a lender in addition to or instead of standard employment income. If you do use employment income, the lender really wants to see an income history. So oftentimes a lender would love to see 2 years of employment history If you don't have that and you have something else, such as extensive training for your job or education, a degree in order to get you into the current job that you have, if it makes up 2 years, that is going to meet most lenders' guidelines for that. Another factor is FICO score. So right now, all lenders are looking at your credit score to make a determination about whether or not you're creditworthy to qualify for a mortgage loan. So I have more information in a future slide about what those scores need to be. Additionally, down payment, assuming, as most people do, make a down payment, we need to know where the money's coming from and those type of funds, and that you have it. And that's critical, just like the other pieces for a pre-qualification. And then we also need to know that you have sufficient funds for your closing costs and escrows, which is something that folks don't often realize when starting the home buying process, is that you not only need a percentage of your the sales price as a down payment, 3%, 20%, whatever amount, but you also do need a substantial amount to cover the costs associated with purchasing the home, and also the funds that go into reserve for your future taxes and insurance as well. So this is just a very rough rule of thumb about how much you may qualify for. And I have the actual calculation in just a moment. But if you are someone who has a lot of debt, generally you can multiply your income by 2.5, and that's going to give you roughly your loan amount. If you don't have much in the way of debt, so you don't have car payments, student loans, credit card payments, personal loans, all of that, you can multiply your income by 5, and that might give you a good estimate of what you could potentially qualify for as a loan amount.
Liz, we did have a question come in the chat before you go on to the next slide.
Yeah.
The question is, what would you need from me if I work for myself?
So self-employed members generally need to have had 2 full tax returns of a complete year. So generally that's going to mean you need to be in your 3rd year of employment for yourself to be able to provide 2 full years. We generally are looking at an average of the last 2 years of your net income for your self-employment. And then we do also look at your current year-to-date earnings, your net earnings, to see if your current level of income is similar or dissimilar from your last 2 years that we've averaged.
Awesome. Thank you. And one more before I let you get back to it.
Yeah.
How are student loans that are paused calculated for payment, meaning no payment is due yet?
Yep, that's a great question. So because student loans that are paused, whether they're in a standard deferment or forbearance, or the federal government's pause of those loans right now, we do know that at a certain point, those loans will need to continue repayment. So even if your credit report is showing a 0 payment, we have to then calculate 1% of those student loan balances and use those as a payment. If your payment is going to be less than that, if you know that this is the case, I recommend providing the history of what your payments were, or asking your loan servicer to provide you with your current payment amount, so that your loan officer can update those as accurately as possible. But we do always have to consider your student loans, even if they're in deferment.
Awesome. Thank you so much.
Yeah, absolutely. So debt to income ratio is this magic ratio that lenders use to decide how much debt you can carry. So historically, years ago, this magic number I'm going to tell you was 32%. And at this point, the number is now 50. So what that 50 number means is that if you take your gross monthly income, so in this example, you have a combined gross monthly income. Let's say maybe this is you and the person that you might apply for a loan with, and you're receiving $10,000 gross. Gross is before any of your insurance and taxes and anything else gets taken out of your pay. The magic number is 50%. So 50% of your gross monthly income here would be $5,000. From this amount, we subtract any monthly debt payments that you have. So this is your student loan payments, your car loan payment, your minimum payment on credit cards, minimum payment on personal loans. If you owe child support or alimony, those payments. If you owe payments for a back tax repayment plan to the IRS, that goes into your monthly debt payments. Things that you pay on your own that aren't on your credit card outside of that. So car insurance, cell phone, those do not go into your monthly debt payments. So in this example, you have $1,500 in debt. So the remainder is what is left for your housing payment. So this is saying that you, as a couple who makes $10,000 gross per month, can have a housing payment of $3,500 per month. Now, this number may be a lot higher than what you would want to pay. This number might also be much less than what you were expecting and capable of paying. But this is going to be the calculation that lenders will use almost across the board, is that 50% figure. Studies have shown that families and individuals are much more comfortable when they keep that number at closer to 30%. So if you were to use only 30% of your gross monthly income minus your debts and your housing payment equaled that amount, you would have more freedom with additional discretional income for you to spend for your own life, and not be dependent on so much of your check for your housing payment. So it's just important to know that this is the number that lenders use, and there are many tools online that will help you figure out how much of a house you can afford based on the housing payment. So you can do this calculation, figure out what that housing payment is, and work backwards to say, if I can afford $3,500 a month for a housing payment, my home purchase price will be X. All right, so this is what we spoke about already about employment. All right, and so I know people generally start right off the bat by looking at properties online on Realtor.com, on Zillow, on Redfin, to try and get a sense of, I like what this house looks like, how much am I going to pay per month for a house like this? But there are big differences between these sites and the tools that they use built into them. So I just want to direct you to the fact that for example, on these two sites, on Realtor and Zillow, a house here, one shows a payment of $1,926 and another shows a payment of $2,349 for the same house. And that's because the tool that calculates them differs greatly in just on how it's set up. So one shows 3% down with no taxes and insurance, and the other one shows a 20% down payment and includes the taxes and insurance. So both sites, in fact, almost all sites, offer a tab where you can calculate and put in the actual information that is relevant to your scenario, and you can get a better estimate of what the payment would look like on a house. So just know that the default number that's on there for a housing payment is not likely to be your actual situation. So this is a total housing payment for a conventional loan. I have broken it down. So in this example, for you to look at, I have a sales price of $500,000 for a house. And we're assuming that this person is making a 3% down payment, which means that their loan would be $485,000. I've used a rate here of 5.125 and a 30-year mortgage term. 30 years is the standard for how long a mortgage will be for most first-time home buyers. So I've broken it down this way so that you can see the principal and interest. Principal, if you remember, is the amount that goes to repay that original $485,000 balance. Interest is the amount that you are paying to a lender in order to have the loan to buy the house. So in this example, this is the first payment, your first payment on this house. You'd be putting $570 towards your $485,000 loan with $2,071 in interest. This is a reality for how 30-year mortgages work. However, those figures do not stay that same amount the entirety of the loan. Every month, the principal amount goes up and the interest amount goes down. On a standard 30-year fixed mortgage, it is not until the 222nd payment of your 360 months that the principal amount that you pay is more than the interest. That is assuming that you don't make any extra payments. If you choose to make larger payments than the minimum, or you make extra payments every year, it's even faster that you reach the point where you pay more principal than interest. In this example, we're considering about $500 per month in property taxes that the lender collects. And then when your tax bill is due, we have enough in the account to pay your town or city. Homeowners insurance of about $125, which is reasonable for a single family home in this area. And then because you are, in this example, putting 3% down payment, and that is less than the required 20% down payment to avoid private mortgage insurance, or PMI, this would have a $222 PMI mortgage insurance payment. So altogether, a total housing payment for a $500,000 house with 3% down, this is assuming a 740 credit score for that PMI rate, you'd be paying $3,488 a month.
Liz, quick question came in. If I were to use Hanscom Federal Credit Union as my mortgage, do you guys escrow for taxes and insurance?
We actually, that's a great question. We do not. So we escrow for your property taxes. We do require that all first-time home buyers have us escrow for to make sure that your property taxes are paid on time, but not your homeowner's insurance. So most people tend to bundle their homeowner's insurance along with their car insurance and prefer to pay that with a discount, to pay it annually, and to handle that themselves. So we don't actually handle your homeowner's insurance, just your property taxes. And for folks who do prefer to pay their property taxes themselves, after 2 years of on-time payments with the credit union, you can request to pay your property taxes yourself if you do prefer to hold on to the money and have them in your own interest-bearing accounts and handle that yourself.
Awesome. Thank you so much.
Yeah. All right. So credit score. So which scores are used? How do we calculate this? What do we do? So we know there's the three major credit bureaus: TransUnion, Equifax, and Experian. Hanscom and almost all lenders are going to look at all three scores from those three major credit bureaus. And we're going to do this for all applicants on the loan. So we are going to use the median or the middle score of the three from each credit bureau. If there are two applicants, so if you have one applicant with really high credit scores and one with much lower scores, we are always going to be using the lower of the two median scores. So that's why it is really important, if you are going to be applying with somebody else, that you understand their credit situation and you are pretty equal in your credit scores. The lower the credit score, the higher the interest rate, or the higher the points associated with getting an interest rate that you want, as well as the higher the rate on a PMI if you are making less than a 20% down payment. And that can have a big impact on your monthly payment by having a much higher PMI payment. So the numbers you want to remember is, to get the best interest rate, all applicants want to have 740 or higher. To get the best PMI rate, it's going to be 760. That said, many people buy homes every single day with credit scores that are less than these scores. It is absolutely possible, and you can do it, and it can be done. Minimum required score for almost all loans is going to be 620. That's the case for conventional mortgage loans, which are the standard. There are a few government loans that will allow a 580 FICO score to be considered. These are not something that Hanscom offers, but there are lenders out there who will offer an FHA product, which may allow for a 580 FICO score, and a few other programs that allow that. So if you are not sure about your credit score, you should change that. Generally, everyone should have a good, strong sense of what their credit score is at all times. And that's one, so that you know that you could secure financing for something if you need it, but more importantly, because a change in your credit score without direct action by you could mean that you've had some sort of fraud. So it's important to have some sort of credit monitoring service. A lot of times your credit cards will have an attached free credit monitoring service that will offer you sort of an estimate of your credit score. It may not be the same score that I would see, but it gives you a good indication of what your credit score is at any given point in time. And I highly recommend that you maybe look at the free scores that's available with any credit cards that you might have. Additionally, the folks in our branches are able to sit down with you and do a credit review if it's been a long time since you've had your credit looked at, and they can assist you in walking you through some steps that you might need to take in improving your score. All right. So we spoke a minute ago about taxes and escrows. So I just want to tell you a little bit more about what that could mean for you when buying a house. So if you know that you have a certain amount that you can spend per month on a housing payment, that could be dramatically impacted by the town or city that you might want to live in. So for instance, in Nashua, New Hampshire, the current property tax rate is $23.22 per 1,000 of assessed home value. So this isn't the value that the home is going to be sold for. This isn't the value that is listed on a sales contract. It's the value that the town or city has determined the home to be valued for at some point in the last year or so. So $23 in this example is compared to, for instance, Woburn, Massachusetts, which has one of the lowest tax rates in the area at $9.33 per thousand of value. So for a home where the home is valued at $400,000, in Nashua, you would then have to pay about $774 per month in property taxes versus $311 in Woburn. So knowing the tax rates is really important, because that's going to have a big impact on your payment and what you can afford. One of the major things to consider, though, is that a $400,000 house in Woburn is going to look very different than a $400,000 house in Nashua. There are many towns that have high tax rates, but you could have a substantially larger property or newer property for the same price point in a town with lower tax rates. So it all depends on what you're looking for. But it's really important to know the property tax rates. Typically, cities will have lower tax rates as the residential tax rate is typically lower due to the amount of commerce and taxes that are paid by businesses in the area. So the more businesses in an area, you're generally going to see a lower property tax rate. So I've mentioned a few times about Hanscom's offer to potentially allow you to buy a house with no money down or a zero down payment. So this is a product that Hanscom offers. It is not a standard conventional mortgage. Not a lot of lenders do offer these loans. Right now, we offer these in New England, Virginia, Maryland, and DC. So it is not nationwide. And there are a handful of restrictions that make them harder to qualify for because we're not requiring a down payment. So you have much less skin in the game. The lender wants to see that you have strong other strong factors associated with your loan application. So for instance, you do need to have a 720 or higher FICO score. That 50% number that I talked to you about before, your debt to income ratio, that's generally 50%. On this loan, drops down to 43%, meaning less of your total income can go towards your total housing payment on this. So in that regard, it's also more difficult to qualify. Although we don't require a down payment, we do require that you come up with all of your closing costs yourself. It can't come from a gift. And you do have to have 2 months of the mortgage payment somewhere in savings. So in a 401k or an IRA, you do have to have, if your mortgage payment is going to be $3,000, we need $6,000 to be in a checking account somewhere saved. So if you were out of work, you'd be able to make 2 months of your mortgage payment. Additionally, this product does not allow co-borrowers that do not live in the home. So for some folks, if they cannot qualify for a mortgage on their own because they don't have sufficient income or employment history or something like that, they may add a non-occupant co-borrower. Sometimes that is a sibling or a parent, and that person helps them to qualify and is therefore obligated to the debt. But typically they are not the ones making the mortgage payment. It is, the primary person who lives in that home. That is not allowed on this type of mortgage product. You need to be able to qualify for this mortgage entirely with your own merits. There are caps on how much of a loan you can borrow. I think this number is actually a little out of date. I think the maximum loan amount is now in the low 600,000, and I can check on that if you guys have interest. It's only available for single family homes or condos, so no multifamily homes. And it is a very specific type of adjustable rate mortgage, which I will talk about in a few minutes. So it is not a 30-year fixed rate mortgage, which is, as I mentioned before, the standard. So I will go through how that works. So we talked about just now the adjustable rate product briefly. So there are fixed rate mortgages, which are typically going to be a conventional mortgage. There are adjustable rate mortgages where rates are fixed for a period of time and then can adjust. There are jumbo loans, which is oftentimes going to be a lower rate, even though it's for a much higher loan amount. And then lenders offer VA or veterans financing loans, and some lenders offer FHA or federal housing loans that have specific programs available for folks who are doing major home repairs and renovations, or construction loans, or purchasing multifamily products. And how you decide on what type of product to choose from, whether an adjustable rate or a fixed rate, oftentimes comes down to how long you intend to stay in the home, or if your income is most definitely going to change. These are important questions. So an adjustable rate mortgage is going to have a fixed period where the rate will remain the same and the interest rate cannot change. So right now, interest rates are about, on a 30-year fixed, are about 5.5% on a 30-year fixed rate. Adjustable rate mortgages have a lower introductory rate. So right now on a 5/1 ARM, for instance, the interest rate is about 3.5%. So it's significantly lower than the rate on the 30-year fixed. And this for 5 years can be a huge benefit to have a much lower payment. If you're buying a home that you anticipate is going to be your first home, and let's say it's a condo and you think you're going to be married and starting a family perhaps, and you don't anticipate this home will fit your whole crew for very long. Maybe you plan to sell it within a couple of years. Having a loan with a really low introductory fixed period for a while might be quite useful for you. You know, a payment can be several $100s higher with a fixed rate than with an adjustable rate. They can adjust after that fixed period, and they can adjust if the market rates are higher. So this example right here with the 5/1 ARM with 2.25 caps is something that is not specific to first-time homebuyers. This is a standard type of adjustable rate mortgage. It means that after the 5 years are up, the rates can change by a maximum of 2% every year, with a maximum of 5% that it can go up over the lifetime of the loan. So if the interest rate is fixed at 3.5%, in year 6, it could potentially go up to 5.5%. And then after many years, it could potentially reach a maximum of 8.5%. There are products that are available specific to first-time homebuyers that have lower caps. They could only adjust 1% per year. We have 7-year ARMs and 10-year ARMs so that you have a longer period. 10 years is a pretty long time to have a fixed rate on an ARM, and there's still substantially lower interest rates than the 30-year fixed. So this could work for certain folks who think, you know, 7 or 10 years might be the amount of time they're in their first home. Or if you are in a program where your income is graduated, if you're in a union position and you know your wages increase every year, and even if rates were to go up 7 years from now, you'd be making substantially more money, and you know the change in the payment wouldn't make a difference. So there's a lot of reasons to consider it, and it's something you can go through and talk to your mortgage loan officer more about. So this is a slide that breaks down that same, we've been using that $500,000 number throughout the presentation, just for you to get a sense of some of the costs associated with this. So Again, first-time home buyer minimum down payment for most folks tends to be 3%, which on a $500,000 mortgage would be $15,000. So a loan of $485,000. Estimated closing costs could be around $6,000. Prepaid items and escrows. So this is several months worth of property taxes. This is paying your homeowner's insurance premium in full. All of that comes. So total closing costs might be around 6 + 4, so $10,000 plus your $15,000 down payment. For a $500,000 house, it's estimated you might need about $25,000 cash to close. All right. And many people have questions for me about what is an acceptable down payment. What that really is for most people, that's money in your checking or savings account. That money has to have been in your account for 2 months for it to be considered seasoned funds. Folks oftentimes will get a gift from a relative, and you would have to have a gift letter attesting that that money has no requirement to be repaid. You could also seek a grant or down payment assistance from a government organization or a city or town. Those are acceptable. Some people choose to take loans from their retirement or 401k. Many people have the ability to borrow at a certain percentage that they repay interest to themselves. The repayment comes out of their paycheck, and it, for many people, is an easy way to access some funds while ensuring that you're repaying back the 401k money that you borrowed from yourself. And then some folks are in the super lucky position that they might get a gift of equity, which would be if a family member were to sell you a house that they owned, and instead of giving you a tangible dollar amount gift, they'll gift you, let's say, 20% of the value of the house, which would then mean that you wouldn't need to make a down payment. And so that's an option for few lucky folks periodically if you have real estate in your family that could be passed to you. So those are the most common down payment sources. And let's see where we are on time. All right, so 1 or 2 more slides here, and then we are going to be wrapping it up. So one of the closing cost items that people ask me an awful lot about is title insurance. Title insurance is the only insurance that you will pay for if you choose to do so, that protects you from the past. So where most insurance policies are protecting you from some sort of event that could happen and impact you in the future, title insurance protects from defects on title that couldn't be found when reviewing the title. So if there was some sort of fraudulent transaction that occurred, someone illegally sold the house that you have purchased. Let's say a decade ago, there was a transfer from one person to another that was done illegally or improperly, or there are liens on the property that were not properly recorded but are in fact owed. These are things in the past that actually do impact you and your home directly. Title insurance pays for attorneys to resolve this and potentially pay out if there are major issues related to the chain of ownership of your home. And it's oftentimes a cost under $500. You pay it one time and you have this insurance for the lifetime of the ownership of your home. You are always going to pay for a lender's title insurance policy. So you pay for your bank or credit union to be protected. You should also pay for yourself to be protected. It does say that it's optional, but it's a very small cost compared to the potential for owing the entire cost of your home to someone who is truly an original proper owner of the home, or it's worth the cost of 2 months of legal fees to resolve something when you just pay a small amount at closing. So I highly recommend, although it says optional, to strongly consider paying for an owner's title insurance policy when you close. And I just want to share with you my biggest tip for how to successfully prepare to buy a house. So if you want to buy a house and you have determined for yourself that you could afford a housing payment of $2,200 per month, right now you are only paying $1,650 in rent. I want you to find the difference between what you're paying in rent and what you will be paying in the future for a housing payment. In this example, $550, and begin making practice payments by putting that $550 per month aside and into savings every single month. If you do this, if you're several months away from buying a house and you do this now, you will have extra money in your savings account that you will need for your down payment or even a couch. You will need those funds, but it also prepares you for when you have to make your housing payment. And you will not feel the burn if you've already been doing it. So this is my best tip to you, is start saving. And the only other thing I can leave you with is to get in touch with a mortgage loan officer. I'm available. If you would like to call me, my phone number is here. My email address is here. I'm available to talk to you about credit, about savings, and all the different pieces that go into buying a home. And if this is the right option for you, I would be so glad to help you with it. Thank you guys so much.
Awesome, Liz. Thank you so much. And I hope I did not disappoint when I said that Liz was a wealth of knowledge. She's been doing this a long time and she is great at what she does. Just as a little FYI for those of us on the call, Liz does work out of our Natick branch, which is locked by security, but can meet you down in the Natick area. And she is also based, at least on my territory, on the Devon's branch as well, which is a public retail branch, so she can meet you there as well. Also, don't hesitate to reach out. As she mentioned, feel free to take a screenshot of this last slide with her contact information. She's very flexible and she will reiterate that she can meet you anywhere if you guys have any questions. Before I log off, I will give it a moment to see if any questions come in. And before any questions come in, did you have anything else to say, Liz?
No, that's it. I wish you all luck, and I hope to speak with you all.
Awesome. And we just got a thank you in the chat. So thank you, Liz, for your time. And thank you for everyone who joined us today. And I hope you have a great rest of your day. And it's almost the weekend. Thank you.